I call upon Chairman to welcome escort Mr. Chinmay here and present a floral bouquet. Before I introduce Chinmay, I would request promoter to dwell upon the startup sphere that is going to happen in June.
Good afternoon, members. I have a small announcement to make. We are hosting startups here in Bangalore on 27th, 28th and 29th of June. So this event emphasizes mostly on startups and people who are into practice of startup ecosystem. The intention of getting this program to Bangalore was to have an entire ecosystem in place where the participation will be across government, the practitioners, and a lot of CXOs, CFOs and CEOs of the unicorns are going to be there, and a lot of ecosystem of startup is going to be built. And we have a plenary session. This is going to be a very big event in which Bangalore has first time hosting. I request all your active participation. There's an early bird registration which is going on currently. I request you all to make use of it and get yourself registered. Thank you. Over to the
Thank you, Chairman. A brief introduction of the current speaker, Mr. Chinamya A M. Chinamya A M is a financial advisor. He works at, as a partner, he works at Advaga Services. And overall experience, he is into specialization of valuation, due diligence, structure advisory, and virtual CFO. He is a past partner at Valuation and worked in M&As, and he has done his internship in DRN, and he has, in terms of seminars and conferences, he is a speaker in professional forums on the topics of valuation, tax and regulatory aspects, practice building and leadership. Valuation course creators in online platform for professionals in the finance space. Frequent speaker in several forums on including IIB, ICAI, ICSI, IDs, Bangalore Valuers Organization, etc. He has written articles in journals and publications on various institutions. He is a chapter member of TI Bangalore. With regard to his academic qualifications, he is a chartered accountant, bachelor from Mysore University. He is also a company secretary, a certified forensic auditor, and a registered valuer. So with this brief introduction, I put Chinmay before you to dwell upon today's topic. Thank you.
Thank you very much for inviting me and having me here today. Thank you very much for the good detailed introduction. And I heard about the startup event which Institute is organizing. Certainly all of us here will support the initiative, and anything required we'll be very happy to contribute, because that is something which is very much near to Bangalore, and we also will support it as possible. And secondly, thank you for everybody to quickly come back and assemble here, because 3 back-to-back sessions and we should not be losing any time in this before lunch. Okay, I'm quickly moving over without too much of background. So first session, Anjan. We all saw many things about complex instruments. Even though topic seems like very small, one complex instrument. What is complex instrument? Okay, that's all about it. But as Anjan was saying, maybe he could have gone on even for months together. And he was saying that whole session, maybe today he could have taken. But I think still it is still very much okay. Like we today in multiple sessions we are seeing different things of valuation. Rightly so for the topic name valuation, the topic today for the entire thing is itself is a valuation. Obviously we need to see it in multiple angles, and none of the things we would understand 100% in depth, but but it is not required also, as I was seeing the response of the audience. Everybody, only one or two people have done valuation, and all of us do not do valuation in our day-to-day affairs. So that's why I feel that now, reassurance for me that the topics and the way it is structured is very interesting. So moving on to the second topic of the day, PPA. Now again, if some of you can share or raise your hands if you have done PPA, you know what is PPA. No one has done purchase price allocation. Okay, Girish should have done, I know. Nobody else has done PPA. Okay. So what we'll do is we'll try to, obviously I think you will know PPA, purchase price allocation, but you would not have practically done it. So maybe what, and so also the slides are structured to take you through from the foundational level. So what is required to understand in PPA is, okay, there are 2 to 3 aspects. One is valuation, of course, and the second important element is Ind AS and the gap, and thirdly about some other areas like income taxation and all, and also fourth element is practically commercially what is relevant. Okay, valuation, Ind AS and gap, and taxation and other laws, and commercial requirements. In all of these things, this session is oriented towards, we'll approach from the commercial angle, because whenever as an auditor, mostly all of us would be looking at PPA, if at all in your work life, most likely as an auditor, not as a valuer to do the PPA, but maybe your clientele has gone through PPA exercise and you are looking at the report. That is a common exercise maybe. Or possibly you are advising a company and the promoter is expecting you to provide some guidance on the PPA exercise, so how you need to contribute in that discussion. And I'm thinking this could be the common need for this set of audience. So we'll be looking at commercial angle, and to an extent we'll try add up Ind AS, because Ind AS is the determining factor for PPA, why PPA is required. And also valuation and other laws also we'll try to cover wherever it is possible. So I'm just starting off with an example. Actually, this conversation happened just a couple of days ago. There is a manufacturer, I don't want to give even what manufacturer also, because it's a sensitive data and you can make out what company I'm talking about, and it's a listed company. So they acquired a couple of groups of companies, one in Kenya, one in UAE. So the conversation went like this. A client was asking, client told us, as soon as they gave the engagement, they told us that, okay, PPA engagement is given. Okay, don't worry about, I'm going to the example without telling what is PPA, that's fine. It's very generic example. I'll then connect it with the PPA. So the client was saying no intangible assets are there. Everything is just in goodwill. You should finish your job in 2 days. This is what typically any job, any client's expectation is like. But we feel it's about 3 to 4 weeks exercise, and not even 3 to 4 days, 3 to 4 weeks exercise. But the client says 2 days and no intangibles are there, we need to go ahead. Then our question, okay, then only plant and machinery, factory, land is there, is it, in whatever acquisitions you have done? They are saying no intangibles, so only plant, machinery, factory is what is there. The client says yes. Then what about employees? Then he says that, okay, employees are there. Of course, employees are there, but there is no IP, right? No, I'm saying there is no IP. So then we need to enlighten them that, okay, employee means it is also can be treated as or thought as assembled workforce. So employee means it's not just that 3-4 people who come and maybe convert some of your raw materials and go. It may also be viewed in a different way. 5-6 employees together may constitute a workforce. 5-6 employees together may, let's say, maybe about 6-7 employees came together with OpenAI, just 6-7 employees, and now we know what is it. So employees need not just be employees, they are also viewed as assembled workforce. So this term we'll see a little more often in the session. Then we asked, okay, does the company has any customers at all? Then the client said, yes, of course, customers are there, but that's not IT. Then we had to again say that, okay, customer is there means then you will have a list of customers, you have the details of the customers, and you have a customer contract with them. Customer contract is also IP. Okay, you don't have customer contract, at least you have an experience of dealing with that customer in the last 3-4 years, then that is a customer relationship, that is also an IP. So these are all things you have, and it's not just plant, machinery and land. These are all other assets which you have already purchased unknowingly. And then do you have vendors? Yes, obviously there is vendors, but that's not IP is what client says. Then we had to enlighten them saying that okay, vendor relationship, if let's say you don't have any of these vendors, you have the plant, you have customers, tomorrow can you manufacture? Obviously it will not be possible. You need to source the materials, right? Where will you source from, who will you source from, what is the best price in which you can source, how will you know the quality of that vendor? So there is an intelligence involved in that vendor relationship. So that is another asset, because it is just cannot be possible tomorrow to start. That is an thumb rule that okay, if you are not able to simply start, then there is something, right? So that intelligence in this case is vendor relationship and the contracts. Then we said okay, these are all few things. Then we said okay, give us the list of employees and including their qualification, designation, salary, and things like that. Then client says that okay, there are some designers also in the employee list. They said okay, only plant machinery. Then they said okay, yes, obviously employees are there, obviously customers are there, obviously vendors are there, and that employee list has some designers. Then we asked okay, what is this designers doing in a manufacturing line? And then like obviously we can't simply manufacture, right? Sometimes customers will give the design and we may need to vet that design whether it is possible to be made in the measurement what they have given. Maybe it may not be possible. After manufacturing 2 lots of, let's say garment thing, after manufacturing 2-3 lots, we can't go back to them saying that there is some design issue. They will obviously reject, they will think that okay, there is something basic we should have checked. Okay, then there is a designing element involved. You have that intelligence also to determine whether this design is implementable. For example, maybe some of the design, how it is looking in a computer screen, may not be possible to be stitched in a garment with some maybe the thread size or thread quality. With that thread size and quality, it may not be possible to be stitched. That's an intelligence you have. So some designing team is there. So that's a different IP. Apart from normal workforce, you have even designing capabilities. And they said, okay, sometimes we also give designs also. We give 5-6 options and they choose it and we stitch it. So it's not just stitching, so you have little more other capabilities. So that is additional IPs. Designs are an IP. And yeah, do you have some data as to which brand you manufactured, how many, let's say to Adidas you manufactured some pants, so how many jeans you manufactured, how many shirts you manufactured, what is the age group, what is the size of the shirts you gave, and whether those shirts you sent it in April or sent it in December, and was the December manufactured things were different and April manufactured things were different. Different garment went into in April, this different garment or different cloth material went into December. So he said obviously everything is there. We want to have this data to ensure that how much we need to procure. We sometimes give bulk order about 7 to 9 months earlier only we give the order, because some of the things it will take time for making the garment. They make the garments just exclusively to us. So obviously we have all this data. Then this data is also an IP. You have the intelligence, you have the knowledge. If I were to be a person who wants to compete an existing brand, then your data is very much valuable to me. Whatever a brand, retail brand knows about their market, almost same thing you also know it, because whatever you are supplying only they are selling. So you also have the data which a retail brand would have done possibly from market research and all of that. Indirectly I can also make up the same data, because what you are supplying to them is they are selling. So you have that data, even that data is also an IP. So yeah, so this is what is the realization in half an hour's call or 1 hour's call, that okay, client may think that their agenda in this conversation was to just completely limit the exercise, maybe to pay lesser fees also, and also get within 2-3 days job done, and auditors will tick off saying that okay, this is done. Then we have to tell them, explain them, no, it is not possible. In 2-3 days it is not possible. It needs a very little detailed engagement. So this is one scenario, one example. I am just trying to explain as to in what different forces PPA engagement can be looked at. We will take slightly opposite example. This is a SaaS platform. The company has a SaaS platform, and it acquired another SaaS platform with a very resourceful team. And the platform is not in monetization stage as of now. And the client says that platform value constitutes about 90% of the consideration paid. Let's say they paid about 100 crores or 120 crores, and they say that okay, this platform is valued 100 crores. So almost the entire thing what I paid is worth for this platform only and no goodwill at all. In the previous example, client was saying that there is everything is goodwill. I just want to close my books. That was the motive. Everything is goodwill. You just park it. No need to do that exercise. Here the client is saying there is no element of goodwill at all. Everything is the platform value. Whatever is the platform, everything is that. Whatever I paid the consideration, everything is for the platform I paid. So there is no goodwill at all. Again, same. Okay, 100 crores I paid. Most of it is for the platform value. Give me the PPA report for the platform value of that. So then we are asking, okay, is the platform profitable? Client says that no, it is not profitable. And there are many other platforms in the world which is not profitable. What is the big deal? Still, entire 100 crores what I paid is value of the platform only. Then we are saying, okay, does the platform generate any revenue? It's not profitable, understandable. Does it even generate revenue? It says no, it doesn't generate revenue, but we have a significant TAM. Addressable market is huge, so we know that there will be revenue in the near future. As of now, there is no revenue. So then we are asking, okay, what is the proportion, does the cost incurred in this entire consideration paid? For example, that means let's say 120 crores consideration paid. What did they incur to build that platform? Have they incurred about 80 crores, 100 crores to build the platform, and then they are selling? Because you are saying platform is too valuable. So our poking question is, okay, how much they have invested in building the platform? If they have invested some 100 crores and they are selling, I understand every entire value is maybe a platform, but is that the fact? So then the client says that no, the cost incurred is very small, but the team is very capable. Maybe next 2 quarters they will entirely build the platform. We know that directionally what the platform is, what it can give, addressable market, what is it. Everything is very clear, very picture perfect in front of us, and within 2 quarters they will build off the platform. That means what? Now the cost incurred is very minimum. Maybe they have spent some 5 crores or maybe even not that also, or whatever. So that is what they are saying. Then what you are paying is actually for few people. What is the platform? I mean, platform is there in your mind. It's not there anywhere. I mean, platform is platform. There is a platform I'm standing. But here in your mind, platform is there, and you feel that entire 120 crores is allocable to the platform. Is your thought process. But with all of these questions, already 50% work done. That okay, it's actually not as simple as that. Everything is for the software. In fact, the software itself is not there, and it's all about your people to whom you are betting on. Your maybe some 20 people, 30 people team is there. That is what in which you are betting on, and you are very clear. All the points, it is not a lie or incorrect statement made by the client. It is just a different way of looking at it. Of course, it is true that addressable market is very huge. Of course, it is true that in 2 weeks or 2 quarters, the entire platform would be completed. But all of this is possible because of the employees who are there, and not really some tangible, intangible is not there. What I mean by tangible, intangible is, let's say a software code is intangible, but you can actually feel it. You can't touch, but you can feel it. You know the software code, you know the data, you know the analytics. So even that kind of software assets are also not there in the platform, because really nothing much is there in the platform. Okay. Then the client says, oh yes, then assembled workforce doesn't provide deduction for my income tax. So this is the issue. Even they heart and heart know that a lot of things what I am paying is for employees. But if I allocate entire value to employees, I will not get income tax deduction, and I would have paid money, but still I will not get any depreciation benefit of it. And that is there probably the concern. While I am not a tax expert, these are my inferences with what the conversation happened with the client. And then I need to say that okay, I am wearing a value add and I don't know about taxation. Maybe you will have 100 different other concerns. But then I can also say that, okay, I can have a coffee with you and I can share a few things. But over email and from a professional hat, I may not be able to do much. But obviously, maybe I can help you out a little bit with what you are thinking. But the issue is that there is a very big gap in expectation, and there is a huge thing which is sitting in the CFO's mind that okay, I am paying 100 crores, I will not get tax deduction. So what do I do? This is the issue which they have, and they are trying to get a PPA done in such a way, and also possibly some advice from RM in such a way to get a tax break in the name of PPA. So now actually the thing, even in the first example and this example, the conversation or the issue as a valuer doesn't stop here. And again, it will continue with the discussion with the auditor, because once we give the PCA report, the statutory auditor should certify the accuracy of it and all that. So what the statutory auditor will ask, they will not see the report and say that, okay, this is the allocation, this is the limit. Okay, first thing, give me Excel sheet. Based on which, actually I don't need to give Excel sheet, I'm an independent valuer, and I can say that this is what is my report. You see what is there in report, all the disclosures are there. But practically it doesn't work. Instead of replying 40, 50 emails, we'll think, okay, take my Excel sheet, you do whatever you want. Then it will not stop there. Give the workings of the working file. There is one working file. Behind that, what workings is there, even that you give. Basically, you teach me how you have done PPA. That is what is the expectation of the auditor. So we need to teach them what is it done, what factors you take it. Basically, entire enlightening session should happen. And after all of these things, some error here and there, they need to poke, they need to feel, but even last remotest of the cell also will not have any error, but we need to prove that it is not there. Then after that, how can you make some judgments? Valuation is not a 1 plus 1 plus 1 kind of mathematics, or it is not also like H2O, H and two components of H and O. It is also, there is an element of judgment involved, there is an element of art involved, there is an element of knowledge involved. Everything cannot be put in mathematics. But still, sometimes audit, I'm not passing any judgment on anybody, but the thing is, they need to work in that way. Auditors needs to work in that way because they want to pass off all the risk possible to somebody else. Because they are taking the big risk of signing a financial statement, obviously they want to pass as much possible risk on somebody else. That somebody else would be largely management, and sometimes whoever assisting is management, like in this case we are valuers assisting in the PPA. So, they would ask for any empirical evidence, let's say discount for lack of marketability. That is something which we would have considered, let's say. So how 20% considered, how 20% considered? Is there a scientific study that 20% should be the DLOM? Like Anjan was explaining in the previous session, there are various elements involved like liquidation preference, and different other contributors will contribute to certain percentage of risk or risk in, let's say, transferability will be there, which will lead to DLOM, discount for lack of marketability. So if you ask me an empirical study by saying that, okay, this is what exactly mathematically 20% is allowed, obviously it will not be there. So that is the, I'm not saying what is right or wrong, but that's the, as a professional, that's the gap. We need to understand what each of the other professionals' requirement and then try to bridge that gap. So auditors will come back with, giving 100% sanctity, 100% clarity in every small needle. And our endeavor would be, as valuers, would be to showcase them and prove them with maximum data which is possible, whatever is maximum data possible. With that, little bit satisfaction would be there, and upon that, the experience or the previous transactions or many other things we may need to explain and prove them according to that. Okay, some of the things are provable, some of the things are not provable, but you can't also disprove me that it is wrong. So the only ultimate thing, what is left is, okay, you prove me that this is wrong. And okay, after all of these things, the report auditor will say that this language I am not happy, that language I am not happy, and okay, that's again another conversation. Okay, what is the better language? What is the better reporting? So I'm just saying very, very crudely I'm talking, not that this way it will happen, but I'm just trying to make it very open, naked as to what is the intentions of each parties whenever you are addressing an engagement, in this case PPA. So these are all the forces and pulls we need to handle while doing a PPA engagement. So some of the questions also I think can be taken in the last session of the group discussion. But still, if you have any questions which is bothering your mind, please ask here only, and I'll try to answer. But if some questions can be pushed to the discussion, we can even take in the evening discussion as well. So now, after getting the context of what we are talking about in the PPA, and slightly going into a few of the specific aspects to give a little clearer understanding about a few of the specific aspects. In the first section, what is PPA, what is the importance, and when is it needed? So as the name itself suggests that it is allocation of the purchase price. Let's say in my example, 124 crores paid. So how much of that 120 crores is allocable to plant, how much is on machinery, how much is on other assets, let's say working capital or anything, and how much is on intangibles. as I was saying, assembled workforce could be intangible, customer contract could be intangible, data could be intangible. So where is intangible? How much it will go there, and the balance will go to goodwill. How much it will go to goodwill. So this is the purchase price allocation. And why is it required? It is required from accounting and financial reporting perspective, because when an acquisition happened, the reader of the financial statement should be understanding as to what exactly is the acquisition. Instead of saying, let's say, a stitching division, and I'm going back to the same garment example, a stitching division is acquired, or a company which dies has been acquired, which puts the die has been acquired. If you say just one headliner, the reader of the financial statement will not know what exactly is the acquisition and how do we need to read that acquisition, whether it is profitable, loss-making, long-term objective, short-term objective. Nothing much can be made out of in the financial statement. So the accounting standard would want the management to provide slightly deeper details about that acquisition, and PPA helps in providing such little deeper insights about the acquisition. And taxation, income tax requires this PPA because tax authorities wants to know, because some of the assets like goodwill is not depreciable. You would have paid some portion of the consideration towards goodwill, you can claim depreciation. Some portion is paid towards tangible and intangible assets. That is depreciation availability is there. So tax authorities wants to be very clear as to how much portion goes to each of the assets, so that depreciation claim is claimed in an appropriate manner. And even in the decision making and analysis, very vital. If a minority shareholder is looking into the financial statement, or a competitor looking into the financial statements, or a maybe strategic vendor or strategic customer looking at the financial statement, they will have a lot more requirement to completely clearly understand the acquisition. So with that perspective also, or even the investors obviously would need to understand a lot more than just a headline of 100 crores paid to acquire so and so. So all of these will be the utilities of PPA. So there can be only two possibilities in a PPA. One is purchase price is more than identifiable assets, that is net assets. The first scenario is identifiable asset minus liabilities. Purchase consideration is more than identifiable asset minus liabilities, which will lead to goodwill. Second scenario is purchase price is less than identifiable asset minus liability, which will lead to capital reserve, or bargain purchase it is called, because you paid less than what you were supposed to be paid. So there is no goodwill, rather maybe there will be capital reserve. So PPA is more in the second scenario. It is both the scenarios it is equally important, but in the second scenario generally it will not arise. The second scenario, because there will be some intangibles which will be there in every business. But second scenario seems to suggest that there is not much of intangibles, and even what is there in tangible also there is some issue, so we have paid much lesser. Possibly that is the case. Or the other case is intangibles are there, but value of that intangibles is so high that your consideration paid is lesser than the value of the intangibles. Then the second scenario will arise. In either of the cases, PPA would be very useful. So typical scenarios when the trigger arises for PPA, in case of slump sale, lump sum consideration is paid. In case of asset sale, it will not arise because maybe this PPA exercise in a different way it is made already by the company and identified each asset what is the value and you purchase. But in case of a slump sale or a business purchase, this need arises. And share purchase, when a share is purchased, there is no need to regulatorily, or as per GAAP, you don't need to do any allocation because share of the company is purchased. But however, when consolidation is done, when the subsidiary is consolidated with the parent, impairment testing needs to be done. So when such impairment testing is done, you would need to prove that okay, this acquisition for these shares, because the veil of subsidiary corporate is removed, and all the assets of the subsidiary will move to the assets of the parent company on consolidation. At that time, we need to show, we need to be clear as to what allocation of value needs to be done for whatever purchase consideration is paid for the shares. So at that time, you need to try and see how you allocate that in the consolidation. Mergers and demergers, similar to some sale example, even in mergers, demergers is required. And even apart from acquisition of anything, even if a control is purchased, we just discussed about the Infosys example where control is also another way of controlling the company or showing the financial interest or participation. Even if financially no transaction has happened, but if control has changed, by which the control in another company is gained by the reporting company, then also PPA exercises would arise. I'll quickly keep on moving, but as I said, please interrupt if something needs to be discussed further. Next section is, okay, now we saw what is PPA, when it is needed, why it is needed. So going little inside of PPA, one of the important element we saw in all the scenarios like slump sale, acquisition and all, is a business combination. Business combination is something which is commonly used in IFRS and Ind AS. So whenever some corporate action is happening, some business combination is happening, 2-3 businesses are merging together or we're acquiring, in such scenarios, PPA would occur. So what is business combination? Then what is business, and some practical understanding. So as per Ind AS, business combination is a transaction or other event in which an acquirer obtains control of one or more businesses. So as here also we see, obtains control. Control can be obtained either by way of let's say slump sale, acquisition, or by share purchase, or by any other means of control. So in all scenarios, it will be termed as business combination. And if the assets and liabilities acquired constitute a business, then it's a business combination. If it does not constitute business, whatever assets and liabilities we have acquired, if it does not constitute business, then it is not a business combination, and the entire PPA exercise itself will not come into picture. So in my example where the client was trying to say that everything is in goodwill, so one step earlier to that, maybe another negotiation they would have done with their auditors is trying to prove that it's an asset acquisition. I'm just buying one plant. I'm not buying anything. I'm just buying plant and machinery. So that is a conversation maybe they will start with their auditors, because I paid 100 crores, that 100 crores is for this plant. So auditor will ask simple question, okay, if you want to buy this from some other vendor, and what will they may charge? They may charge 40 crores. Okay, why are you not buying from them? Then the story begins. Again, same thing like how how my conversation went with the management. Similarly, they'll say that, okay, if I buy 40 crores, then it will need time for installation, it will need people for installation, it will take 6 months to install, and again, there were some employees also. I bought the plant, but some employees also were there, they also came, I need to hire them separately. So all the story continues. So what I am saying is, there is a decision making involved in categorizing it as business combination at all. Whether it is an asset purchase or a business purchase is a decision making. So there, if only one separate plant is purchased, maybe it is asset purchase. If along with plant few other things are purchased, then it is a business purchase. Just drawing a reference of income tax. In income tax, there is a definition. I think most of you would have heard this: lock, stock, barrel transfer should happen. There should be one wholesome consideration. Consideration should not be determined for each asset and liability. That is what Income Tax Act also defines. So some of the elements are common compared to the gap and business understanding as well as income tax. That if an asset is exclusively purchased with a determined consideration, it may be an asset sale. But if something more to do with is there, then it is a business acquisition. So in business acquisition, this PP exercise will apply. Otherwise, it will not. So what is business? India is also a lot touches upon what is business. So I am not going to too much detail of it, but there are 3 elements: input, process, output. Even though output is not there, still it will be a business. As long as input and process is there, still it will be a business only, even though output is not there. Rightly so. Okay, we will take few examples in the subsequent slides. I will not touch upon it, but as of now, what we need to know is, as per Ind AS, input, process, and output is there. Input and out process is qualified that whatever I am evaluating the target as whether it is business or not, as long as input is there, that means maybe raw materials, employees, or whatever, and some process is happening, then it is a business, and need not be that output should be there. Okay, we'll go to other examples, but right away, let's say a startup which is not provided services as yet, it is still in the stages of R&D. Or maybe a drug manufacturing company is still in the stage of R&D. Maybe that is a case where we would need to evaluate, even though output is not there, whether it is still business or not. In layman kind of view, obviously an R&D setup, if it is there, it should still be business even though the ultimate drug has not been discovered yet, or ultimate drug is not manufacturing, the ultimate drug manufacturing is not started. So that's where the relevance input process is there, still it is a business, need not necessarily be that output should be there. Okay, that example I was referring, so a pharma company is in the R&D phase, commercial production has not yet started, trial runs are done, and the production planning is done, equipment is being purchased, such equipment is being purchased, and along with the equipment, still workforce and research papers, know-how and everything is there, whether it is a business combination or not. It is not? Is it a business combination? Yes, because as I was saying, output, we don't need too much worry, input process is there. Another example, a real estate company with newly constructed the commercial property intended to be let out. Commercial property is constructed and it will be let out. Sales, administration, maintenance team are yet to be hired. And acquirer is a business entity which intends to purchase the property for its own use. Completely constructed property is there. Real estate developer was about to market it and lend it, and this acquirer felt that okay, entire property itself is required for my use, and they are acquiring this. Is this a business? Yes, it's an asset because here there is no output and there is no, it will not be there also in the future. So it is an business. It is not a business. Okay. Now we saw PPA. We saw what is business, what is not business. After categorizing the business, everything, all the filters are funnels is sorted. Now we are seeing okay, what is that we would need to identify. Like I said, assembled workforce is that. So the right terminology is identifiable assets. In identifiable assets, there will be intangible assets and tangible and other things. So we will see a few of those in this section. Okay, there is a recap, but I think this is all clear and I don't want to spend any time on that. So key element in this identifiable asset is the asset should be separable. If there is a combination of 2-3 assets, then again that itself will that itself need not be together viewed, because if we view 2-3 assets together, maybe we are missing out something in between, or some of the valuation is not rightly captured in the group of assets, or maybe the articulation or the nature of assets could be different. If we are viewing something as a group, maybe some of the nature of assets which is inside that. For example, if I just say website may have software code, website may have platform fee paid to let's say whoever the website vendor, and maybe some of the people, let's say some 20 people are exclusively working on the maintenance of that website. So if I combine all 3 together, then the way I look at it and the way valuation is attributed to that may be slightly different than looking at the team separately and the subscription fee paid to the website service provider separately and the software code separately. So what we need to be clear is whatever asset I'm looking at, this process when it starts is when we are starting the PPA, we will start listing out okay, what all assets are possible. Like I was saying in my example, the client may say that okay, we have acquired a plant. Then we will start listing out okay, we have acquired a plant. Then there is warranties. Then there are employees. Then there is installation. So even in a physical plant itself, there can be multiple other things. So just imagine when it is in the mode of a software or a technology mode, then there may be a lot more intangibles which may be possible. So this exercise is to identify each of the assets, whether it is asset or not, as long as separable nature is there, like I said, capable of being separated, and it can be separately sold also, and sold or transferred or licensed, then that is a thumb rule kind of a, we can apply that thumb rule to know whether that is asset or not. And whether assets arises through contractual rights or legal rights, how the asset is arising is also very important, because that will also determine whether the nature of the asset, and also I'll just take one example which may come out later also. An employee, right? We were talking about 5 employees, 10 employees who are the key to come up with the software. that employee, if I look at as 5 people, a group of people, technology engineers who are having some kind of, apart from just being full stack engineers, maybe some of the platforms they have worked on, and that's why they are little more experienced in that particular platform. So there's a niche technology on which these 5-6 people have worked. So that is can be looked at as one, let's say, assembled workforce or a group of employees. And the very fact that maybe the company has a contract with that employee for, let's say, next 2 years, this may change the color of the asset from assembled workforce to a contract, employment contract. It is bordering or lying in between, let's say, having an independent third-party contract. Let's say in another scenario, there is an independent third-party contract with a company to build that platform, whatever these employees are capable of building, to build that platform. If we have a third-party contract on one end, and on the other end, I have the set of 5 employees. Like 2 ends are there, 2 different ends, but both the ends will give the same results, the platform it will give. So at one end there is no asset at all, it's just a contract with a third party. On the other end, this employees are there. So combining these two, like if the company has entered into some contract with the employee saying that 2 years you cannot leave, your all entitlements is whatever you earn is dependent upon what will happen after the end of the 2 years, what you will build, and like that a very clearly binding contract is there. Then maybe the way I look at it as the asset, the character of the asset may be slightly different. I may look at it as a contract rather than an asset. So this way, this is an example to let you know that in what way, what hat we should be wearing while doing this exercise. So very critically looking at each of the things as to where the value creation is coming from. What if, let's say in my example, 120 crores is paid, why exactly you paid? What exactly is the reason why little bit more is paid than what is there in balance sheet? So when we critically look at that, these are some of the things which will give us different flavors, and after looking at all of these things, we need to take a call whether what kind of intangible is that which is being valued. And the reason why it is very important to classify is for each of the intangibles, also once we classify, the way we look at it itself will be different. If it's a group of employees, then for example the utility, what rewards and returns the company obtains will be different than a contract. And we'll further go through on different types of valuation. Some of the methodologies are also, it is generally accepted that a few methodologies are better to be applied to a particular type of asset. Some of the asset types are maybe some of the methodologies are more useful or more apt for some of the types of assets. So that's why it is very important to classify rightly know what asset I am talking about. Okay, I came to this. Sorry, something more. Yeah.
The example that you gave of the workforce, wherein it is contract or without contract.
Yeah.
How exactly will the valuation be affected? Because at the end, I get the same product, right? So at the end, I get the same answer.
Yeah, a lot of things will change. For example, simple aspect, if the contract is there for 2 years, then I am very sure that 2 years these people will be available. So the completion of the project will be more likely if we have that contract, rather than if we don't have. It's a very, I mean, like any other employment contract where contract, I mean, it will not have the bond kind of thing. So in which case the predictability is much more lesser if it is just an assembled workforce.
Okay. So that way, if it is a contract, I'll allocate more value to that.
I don't want to come to the conclusion of more value or less value. Possibly little more predictability will be more in that. Yes, or that may lead to little more allocation of value, or some of the probabilities will change. Many things may change, but definitely things will change if they are looked at in a different way. And also to look at it another way, anyway, as an independent valuer, when I am looking at it, whichever asset it is, if I am completely open-mindedly, I am looking at it, I should come to the same conclusion as long as everything is taken care. But once we classify, it will become easier for us to predict what questions to ask. If it is an employee, I know these 10 questions to be asked. If it is a contract, I know these 10 things to be said. It will make our life a little simpler by classifying better. And also, as I said, some acceptable or generally adopted methodologies are there, which everybody will adopt such methods or approaches of valuation for such category of assets. So that way also it will become a little easy for us to proceed. So these are different, actually.
more value for the buyer from buyer's perspective is purchase price.
Yes.
So normally to arrive at the purchase price only they would have done this exercise before
Yes.
paying a price.
Yes.
Then why again the purchase price execution money?
Yeah. So one possibility is they would have already done the entire exercise, and if the entire exercise they would have done it for determining the price. Now this exercise is an independent exercise. Even though it is done for the accounting requirement and for taxation and other requirement, an independent PPA report is required. Even though they have done it, now independently it has to be done and better than what they have done is in line. This is one possibility. Another possibility is maybe they would not have done it. So now it is required. Third possibility, which is very common.
They're just paying a lump sum without going into detail.
Yeah, possible. Many times it is possible. See, third possibility I am coming to, which is 90% of the cases. See, business transaction, business decision would happen many times largely with gut feel. Sometimes maybe they would have paid more also. It's okay, I just need that plant. I don't know what is it, tomorrow I'll figure out. That's the businessman's mind, right? If everything, generally businessman does the decision of lot of things which will not be clear in their mind. That is why there is an edge. Otherwise, in an even world, if things are very clear, like in this pattern, if everybody can think through the way a valuer think, it is very even, very right. There can only be one value. Then what is the entrepreneur's contribution in the business? Everybody can do the business, everybody can do it. Generally, things will happen with a little bit of gut feel and lot more with unscientific things which is there. And that is exactly the reason also here some goodwill or capital reserve arises. Otherwise, everything should 100% match. The reason why goodwill capital reserve arises is because there may be a lot of element of judgment should be there in an entrepreneur's mind, and many other reasons should be there, because of which it may change also. So these are different intangible assets we've just listed out, along with the way in which it can be classifiable. One is marketing related, trademark, trade names. There are multiple things within trademark only, like corrective marks, service marks, trade dress, and different things. But it is all from the lens of the marketing. How the look and feel of the brand is there. From that perspective, there is a value to that, and that's why that's an intangible asset. Then contract based, there can be licenses, royalties, and such kinds. Permits could be there. Let's say tolls could be a good example for permits. Franchise agreements, user rights, like drilling rights in a mine and water wells, servicing contracts, and employee contracts as we discussed. So these are all contractual based intangibles. The value is coming only because they have the permit, they have the contract. Then technology based patents, R&D, databases we discussed, trade secrets, secret formulas, codes, software codes. So these are all technology based. And then customer focused, customer centric, this also we little bit touched upon. Customer list itself could be a, for example, let's say Just Dial, it's not just about the list, but also like I was saying in my earlier example, whether I supplied in April or December is a information or an insight. Like in case of Just Dial also, which customer, which area, which pin code, what did they order, whether they're a family or they're not a family. Like that, it can be many things can be possible just with the data and the list of customers. And customer contract we discussed. And even though there is no contract, like I was saying, how many years you're working on with them? You're working for from 3 years. So initially, was it easy, or now it is easy to deal with the customer? Obviously, initially the work order size was very lesser. Customer will give the initial orders with a smaller number of units, and you would need to spend, let's say, about 2 months to onboard a customer. But today you are spending only 5 days to onboard. So apart from just the contract, which may assure revenue for next 1-2 years, but the relationship itself, there is value in the relationship itself which you have built over a period. So that is a separable asset from just the contract itself. And non-compete, the assembled workforce is the last thing which we discussed. So these are all different types of groups of intangible assets possible.
How do you actually determine the useful life for all this?
Sorry.
How do you determine the useful life for all this?
Each one is very different. Contract, it is simple based on the time of contract. Let's say technology based, is a lot of things will involve in technology. For example, what is the type of technology, what is the market which is there for the technology, It may be just two years, some of the technologies may just be 2 years, some things may go for 5 years, 8 years. So each one is very different. There are a lot of studies also would be available, let's say for a particular intangible when we go in detail, there will be a lot of studies also would be available. I have 1 or 2 slides which I have picked up from one of the studies which I have shown. Though not for this, but I am saying there is lots and lots of studies in the respective industry would have happened. Many things would be open source documents also in the available. Some of the things may be available based on HR. So a couple of practical scenarios. Acquisition of a data management company where data is the key asset. Data is not recognized in the company's books. For example, S&P or Traction, their data is everything for the company. So if somebody is acquiring, let's say, Traction, so whether the data what they have, is it an IP or not?
Public data.
Sorry?
It's public data.
It's a public data, correct. What is there in, let's say, Traction, is there in MCA, is there in their respective company websites, it is there in all over the place. But
Here is there in one place.
yeah, there is lot of utility with it. The fact that it is there in one place and the way you can retrieve it, there is lot of utility. So one answer was public data. So anyway, there is no clear answer. The thing is, especially for the things like S&P and Traction, I don't think there is any doubt that there is any value. Obviously, there is value towards it because of the very fact that the way the data is available with them. And some of the data, what they have is also subscription based. Some of the data may also go by first level research of people being there on the foot on the street. So with all of this, I mean S&P and kind of companies, it is very clear data is asset. But you and I can face a lot of companies where this clarity may not be there. So there we need to apply our judgment and research more and then see whether this data is it valuable or it is just like it is anywhere there and there is no value to it. So in this example, it seems like maybe for Traction and S&P and such companies, definitely data is an asset, even though it is not finding place in Traction's book. They may not have anything in the balance sheet saying that data has an asset. But if somebody buys it, that needs to come in the balance sheet as a data as an asset. Yeah, I think there is nothing much in this. So these are little interesting things. B2C SaaS company versus B2B SaaS company. How do we treat customer relationship? And along with customer relationship, I'll touch upon vendor and other relationships. So B2C companies, customer relationship is possible only if there is little bit of stickiness. Because B2C companies, there is not too much of B2C SaaS companies. Let's say I use Zoho. So what relationship Zoho has with me? Tomorrow I may migrate to something else. So, but if there is a lot of stickiness, then for Zoho customer relationship, customers may be an asset. But if a lot of stickiness is not there, then it may not be an asset. So we need to accordingly decide. But B2B SaaS companies, generally customer relationship can be recognized as an asset because a lot more engagement will go with each particular customer in B2B than in case of a B2C company. So this is the way in which we need to analyze whether it is actually an asset or not in respective companies. I touched upon a little bit more in each of the, going a little deeper on, let's say, in this scenario, first scenario, self-brand online B2B versus multi-brand offline B2B. There is one online B2B company is there, then multi-brand offline are there. Customer relationship, yes, in both the cases customer relationship will be there. Apart from that, vendor relationship which touched upon it, in both online versus offline, because you are getting the materials to the market, you need to obviously would have established already vendor chain, supply chain and everything, so that is an asset. And one more thing comes, distribution channel. In this case, distribution channel itself may not be there, like in case of an FMCG or something, distribution channel itself may not be there. So it's not that there is no asset there, but distribution as such cannot be recognized separately. There is nothing to recognize separately. What is there may already be there in customer relationship. So multi-brand offline B2C. So again, the thought process is similar. So now that I have only 6-7 minutes, I'll go a little bit faster, but this slide will be available. You can much more detailedly go through and understand, spend little time on each of these combinations and see really very interesting slide this is, where customer relationship, vendor relationship, distribution channel is very much detailedly analyzed in multiple different scenarios, online, offline plus online. For example, this third scenario is where they are selling only in Amazon. Amazon, I mean maybe Amazon plus Flipkart, whatever multi-brand platforms. Only they are selling there. You don't find their products in, let's say, stores. For example, Neiman's is a brand you would have heard. They have their own store, and then they're in own online store, and then maybe Amazon or something. There may be some of the products they can't even afford for their own web platform, and also they may be only selling in Amazon of the world. Then the last category is self-brand omnichannel. So self-brand, they have their own brand. For example, maybe Mama could fit into this, where it is across the chain of things there. This is another practical example about the assembled workforce. This is also a very interesting example. First scenario, let us see first. XYZ acquires a tech team of ABC along with the related tangible assets and customer contracts. The tech team, what is being acquired from ABC, was providing tech support to another company called Big Corporation, so which is also a customer of XYZ. So the team what was serving my customer, I am acquiring that team from my competitor company or my ancillary company. I am acquiring a team which was serving my customer. So whether this asset can be recognized as assembled workforce or not. So here, any thoughts? Possibly in the start of the session, maybe there would have been more answers than now, because now you are made you think in lot more different directions and things. But anyway, all of this is directional thoughts, obviously, and now I think this would help you to think in a little different directions. And I hope that's why, even though it is little confusing, hope it is not. It is for the good confusion. So let us see scenario 2 also, and then try to collaborate and take answers. Scenario B: Belcorp acquires a network support team of Yes company along with related tangible assets. The network support team of Yes company was solely serving Belcorp and before the acquisition, and the acquisition integrates that. So there is a team which is there in another company which was supporting my company, some of the process in my company. Now I am acquiring that team. In the earlier example, I am acquiring a team which is serving one of my customer, which was serving one of my customer, and now I am acquiring that team. So now that at least little contradiction is there, can you think and contrast, and whether in either of the cases whether it is assembled workforce or not?
In the first case, it is identifiable and separable as well.
Correct.
Second case, identifiable but not probably separable because it's under the vertical integration.
Yeah, again, direction of thinking is absolutely right. It is subjective. Some cases it may be separable also in the second scenario also, but direction of thinking is right. And yes, as you inferred, and the answer is also in the same direction as you were saying. In the first case, it is identifiable, separable, and also the output also will change. My client delivery will happen with that same team. So it is likely that this team would be identifiable assembled workforce. But in the second scenario, majority of the things are ticked, but it is for my internal use, and that my outputs would not change, and it may not have a revenue generating capabilities. That's why we may fail to identify it as assembled workforce. Okay, this is a little interesting slide. We took it from one survey report. So if you see here, there is a pattern of goodwill and tangible assets and intangible assets in different sectors. If you're going from the bottom of it, sector is mineral and energy, and in this, if you see that very minute component of goodwill is there, and also very small components of tangible assets are there. The blue is goodwill, the reddish one is tangible assets, and the intangible assets, reddish one, and the green one is tangible assets. So here, maximum is there in tangible assets, little bit intangible, and very small portion in goodwill. In case of energy and minerals, I think we can even resonate with this, right? In minerals and companies, even it's not that this is only percentage. It's not that quantum of goodwill is very small in minerals extraction company or something, but the tangible asset pool is such a large. Heavy investment would go in tangible asset pool. Comparatively, the goodwill amount will be very smaller. Just drawing the opposite end of it, services company. So tangible assets obviously very small portion. If you take ITES especially, at least in IT and services, there is still some amount of, let's say even the number of laptops will be more, the subscription databases will be more costly, and so that's why there is little more portion of tangible assets. But in case of ITES, obviously very minimum, and nowadays maybe largely it would have been affected or skewed from work from home also, because the only asset you have, especially in ITES, large asset is the workspace and related asset. That would have little bit reduced the tangible asset portion. So if you see, the goodwill component is very high in services and ITES segment. Another interesting observation is life sciences and these kind of companies where you see a lot of R&D and all goes, intangible portion is more, even it is higher than goodwill. So this slide actually I found it very, very interesting, where it will show us what company where PPA is there, whether it is in line with the industry benchmarks. So if I am valuing a, let's say, mineral or energy segment company where the management thinks that 40% is in goodwill, then it's an indication that obviously what they're saying is wrong. We need to see and figure out in what way we should challenge, and we should see that right number is arrived. And similarly, if ITES company is there where if they say that goodwill is very minimal, then obviously what they're saying is wrong. We need to see in what way that needs to be brought out in the. So this is from the same data but slightly differently put. This is a deciphering of the intangible itself. Within intangibles, how different industries account for different types of intangibles. So, for example, consumer products, if you see, there is a lot to do with the trademark and the customer side of it. When I said in the classification of intangibles, we saw the first segment where trademark and related. In the consumer branch, you can see that 60% is there in trademark and rest in other intangibles. Because lot of consumer products, the main asset is the look and feel and the recall of the customer. So a lot of things is concentrated in that, and very limited in other intangibles, being contracts and other intangibles, very limited in consumer segment. And I'm just trying to see where is the smaller. See, let's say real estate, just 14% is in the trademark and things, and large component is there in other intangibles. So there may be many other intangibles which is not classified, and large portion has moved in other intangibles in real estate. So this also gives a clear benchmarking. At least we know which industries, which kind of intangible also is there with this study. So after knowing all of these things, as I was saying, the balancing figure would be goodwill. So the goodwill, what is the reason why goodwill is coming? Would be, there may be many things like synergies, growth potential. Okay, assembled workforce, I was touching upon earlier also. As per the tax laws and also to an extent from GAAP, assembled workforce cannot be separately identified as an asset. However, one caveat is there, if the assembled workforce itself, like in my earlier examples, if the workforce itself is a key contributory of the business and revenue, then it may be possible that we can identify that as an asset. But especially from income tax perspective, it will be very challenging because they will not understand whether what is it, what we are talking about. Assembled workforce is not allowable, that's the only thing which comes to their mind. But at least in accounting parlance, you can little see if that can be recognized as asset. But in largely, assembled workforce will go with the goodwill, it will not be separately identifiable. So other organizational aspects may be there, apart after allocating value to everything, still there may be some more value which is left, which is in goodwill. Some of the reason may be the culture, the way organization is driven can also be contributing to the goodwill. And other than this, there can be wrong calculation and as the other person was saying, maybe management has not computed rightly and they have not valued the business rightly. Because of that also goodwill may arise. As a valuer, when I independently value, maybe I will come all asset put together, I will come to 100 crores, but they have paid 120 crores. Even though there is nothing is there, let's say there is no synergy, there is no growth potential, still they may have paid more, it can still be possible and it will still be in goodwill. Even though they have paid more, it will still be in the goodwill. From the accounting perspective, there is no different way of recognizing this. Yeah, overpayment is the last thing. So, okay, this is, I'll just skip. Okay, coming to, I'll take maybe 2-3 minutes extra. Already it is 12:30. I'll take 2-3 minutes more extra and cover this last aspect. This is the type of valuations, type of intangible asset valuation. Again, like in the normal valuation, how it was covered in the first section, even in intangible assets also there are similar 3 approaches. Income approach, market approach. Instead of net asset or asset approach, it is cost approach. So income approach, first is, I'll go sorry. First is meme approach, it is called multi-period excess earning approach. So this is similar to, okay, as it is income approach, it may look like the sheet may look like a DCF approach. The difference is in this approach, in simple terms, the entire valuation is captured from the future revenue of the company, of the intangible. And then because we are valuing only one intangible and not the entire company, all other things we need to remove. We'll start with the revenue and then we will remove the all other assets. The way it is removed is when you see here contributory charges. So here each of the one on this revenue, what is the derivation of this revenue from a tangible asset? How much portion of this revenue is derived from second tangible asset, third intangible asset? Let's say if I am valuing software, how much of this future revenue is contributed from workforce or customer contract? That will be excluded here. Entire revenue is taken here, and other intangibles and tangible assets portion of the value is excluded here, and finally we arrive at value of the target intangible. So meme is an approach where we take the revenue and exclude all other assets value. And relief from royalty is many times it will be not the main key contributory. RFR can be used only in cases where we are valuing an intangible which is not the key contributory for the operations. So that it could be brand, it could be a license. So otherwise also business will function, but this is how it is. I mean, when we value this license, you apply the royalty rate. So the way it is done is we need to study what is the royalty that the company would have paid if they didn't have this permit or if they didn't have this license. Then that opportunity cost which would have been there would be the value in this method. Then with and without, here too will value the business twice. With the IP, without that particular IP I am valuing. Whatever is the difference is the value of that particular IP. With the technology, what would be the cash flows? Without the technology, what is the cash flow? Difference is the value of that technology. So cost approach is more like how, to study if you want to recreate that technology or whatever the asset, how much I will spend, that is the way of cost approach. There are a few other assets I wanted to translate, but I think it's a self-explanatory slide, maybe you can go through the slide. These are few specific considerations I think you can go through on this later. These were all, I think, any quick things?
Yeah, sure.
Yeah.
So I'm doing an acquisition and I acquire a brand also as part of it. My intention is in the future I don't want to use the brand name, I change the name. Do I still allocate something to brand name as part of the allocation or?
Yeah, it is always based on your, actually what you do is important than what it was to the seller. So you will see it from the perspective why you are not using it, because you either, if you sell it also maybe it is counterproductive to you because somebody else may spoil your market. So you are not using at all, so there is zero value to you and you should not be recognizing the value to that.
And if let's say I'm buying out the business just to kill off the competition, then in that case,
so it should be, everything should be there in goodwill in that case. Ideally everything should be there in goodwill.
Can I say it's non-compete if I have a condition saying that you cannot do this?
Yeah, non-compete cannot be identified as a separate asset. As such, it will be a goodwill.
Goodwill.
Sure, then. Thank you very much. Again, we'll if any other questions, other maybe in the evening session we can do it.
May I call upon Chairman Pramod to welcome our next session speaker, Mr. Girish. Okay. a request upon to hand over a memento to our speaker Chinmay. Sir, please. May we have a big round of applause, please.